Thanks for tuning into Talking Point. I'm your host, Niraj Shah. There's nervousness around markets, and there should be because the narratives are constantly shifting from beneath your feet. And that will be some of the talking points with our guest today. Our guest today is Prateek Agrawal of Motilal Oswal Asset Management. We'll ask him whether debt markets are actually more attractive than equity at the current juncture. Motilal Oswal AMC believes rates will come off. We ask Prateek, what if they do not? Why are Indian markets expected to bounce back extremely sharply in a period of tepid growth, ex banking, of course? Would China opening up benefit commodity related businesses? And can urban discretionary start to see pressures? These are some of the key talking points in many that we'll have with Pratik Agarwal today. He joins us. Great having you. Thank you for joining.
Hi, good morning.
Very good morning. I think I want to start off with how do you look at the global landscape from your vantage point, considering that the conversation around peak rates has now just gotten extended further, and we do not know when the reduction comes, even if there is no further hiking of rates after the next 2 or 3.
Yeah, so the thought towards peak rate has definitely changed. We are now talking higher for longer, and that has implications on growth. For example, real estate is a big engine of growth, and in the US, it is definitely falling off the cliff. Over time, it will start to show up in numbers as well. Now, some of our export-oriented businesses could see going tougher as we go forward. But let us look at it in terms of goods export. Exports are 18% of our economy. A 1% drop in global growth takes away 18 bips, of our growth. So just to put it into context, and a lot of what India exports is not the expensive stuff. So you have two counter and maybe tailwind supporting our exports. One, that when people downtrade, for example, an Indian good may be picked up over, let's say, some other region's good. And mind you, today there is a substitution effect as well. With, let's say, we compete with Pakistan, maybe a Bangladesh, Sri Lanka in garmenting, leather goods, maybe also a Turkey. So there is some amount of substitution even in traditional exports. So that somehow in the modeling is very difficult to build in. So that is one tailwind, and second, down trading could also provide us with some legs. So I'm not as negative. So let's assume, and of course, newer categories emerging. So if you look at the export data, one space that is really growing strongly is, let's say, cell phone exports. Now they were not there 2 years back. So newer categories are emerging. Maybe China plus one. Maybe as the globe wants to have multiple sourcing destinations other than only one. So, and whenever a new thing happens, the modeling takes into account ceteris paribus. It's very difficult to build in new changes that are happening. So one should not be very negative, but yes, slower global growth hurts us. I think in some spaces, and that we should build into assumptions. The other big thing that is exported out of India is software services. Now, software services, so one thought is that there is a slowdown, and hence, will people do capex on software kind of stuff? Well, they may do less of capex on software, but then they will have more of cost takeout deals. Where, given the healthy balance sheet of Indian entities, we should turn out doing a good job. And second, what is surprising market period after period is wage buoyancy. Not that too many people work on software in the West, but if there is wage buoyancy, then it just makes Indian IT that much more competitive as well. And there is no substitute globally. So if you want to get IT done, you come to India. So even there, versus earlier, the outlook is not as bad. And there could be positive surprises versus the commentary that we keep getting, because every day you hear about slowdown and the effect thereof, but the positive data point comes once in a quarter kind of a period. So in the interim, people will try and hunt for a good news, and that would be scarce. So that is one thought, and then so that is export. Let's take 0.1, 0.2% damage to GDP on that count. Now the next thing is India. So outside interest rates increasing, does it force our own RBI to increase interest rates? Now, till now, we have seen RBI doing it 25 bips lesser than the West. I think what has given RBI a lot of freedom is our forex levels. When they were dropping, the need to be lockstep with the West was very high, to my mind. Now that we are again seeing forex increase, that need has definitely reduced. And if forex stays good, I think the degrees of freedom that our policymakers will have will be higher. So that is something that we would always want to keep an eye on. Now, if Indian rates don't move up further, okay, 20, 25 bips fine, but don't move up further, then I think we are at rates which we have always paid. So it's not a jolt to us, unlike the West, where rates were very low for very long, and the higher
Correct.
rates are definitely causing a hit. So now with capex cycle coming in, with government capex focus being strong, and now even industrial capex stronger, I think that 18 bip kind of a loss should be made up. So yes, 24 fiscal 24 over fiscal 23 should be expected to be a slower growth year. But if we end the year closer to 7, we should still end up doing 6% real next year, with around close to 4% kind of inflation, so 10% nominal, which is the budget max also, by the way.
Yeah, but does that therefore make equities at the current juncture um, remotely attractive, or is it that as a wider asset class, maybe debt becomes more attractive?
No, so this is something that we have been saying very clearly. Let me put it in a manner that people understand. In debt, you put money in a safe. Now, even some of the banks are probably doing 8% FD rate. So you put money, you get 8% with certainty. Now, you put money into equities, people will build earning increase kind of returns. Earning increase is also 25 over 24 kind of returns expectation, right? So let's say 13, 14% uncertain with volatility. So that becomes the equation. Now, this equation changes very rapidly. Let's say you go a quarter hence, quarter forward. You put money in debt, you will again make 8% with certainty. You put money in equity, suppose equities have done nothing over a quarter, which is also what our view is. We will probably consolidate for a quarter. The equation turns into 3 to 4% extra, because earnings are compounding and markets are same place. Okay, and equation becomes 8% fixed versus 15, 16% uncertain for equities. So that is the manner of seeing equities. And as you go forward, hopefully, there is a question mark on rains and heat and all of that. But hopefully, as you go towards the end of this fiscal, you start to get some amount of tailwinds of interest rates peaking out and then maybe starting to decline, which would
This
help
year, you are saying interest rate declines?
towards the end of this year. Yes, there is at least peaking out. So peaking out, two more rate increases even now in the Indian context is
Indian
max.
context. Okay, fine.
And after that, hopefully, if the world doesn't increase, we could expect, and forex stays good, we could look at declines. So that remains in the realm of expectations. So then I think as we go forward, equities will get its fair share of allocation.
Manish, so the other thing, Prateek, that a lot of people are talking about is that when you look at the current earnings season, while the overall aggregate numbers may not look as bad, ex banking, the numbers have not looked good at all. I mean, sure, an auto would have done well, sure, IT surprise, but by and large, wasn't impressive. So, how easy it is to predict what earnings growth could be in a scenario when management themselves are not completely confident of how earnings pictures would shape up across various industries.
No, sure. So this time on the earnings season, if you knock off commodities, metals and oil and gas, the numbers were strong. If you knock off banks as well, numbers were okay. Okay, because autos are a large part of the earnings on the manufacturing side. They did well. Capital goods companies did very well. What disappointed was discretionary retail kind of spaces. So now the slowdown there should be expected to continue for longer. I mean, de facto, if interest rates move up, salaries have not moved up. They may move up in April, but till then, the household is paying that much more money for interest and has that much less for consumption. So, for at least one more quarter, one should theoretically expect consumption to remain slow. But other spaces, I don't see a reason for being disappointed. That stays
Okay.
reasonably strong. So, unlike in the past when consumption was the sole driver for our growth, now we have more engines. Capex is definitely emerging and seems to be sustaining for longer. Whatever data points you see looking at industrial capex, roads and all are very strong, that we all know. But even for industrial capex is getting stronger, not getting weaker.
Got it. Okay. Pratik, may I ask you then, choose any year in the last decade, any year, and you might have been X percentage in consumption related themes and Y percentage in non consumption, capex, industrial themes. How was that X and Y currently compared to what it was then, whichever year it may be?
Yeah. So over the past 10 years, portfolios have tended to be more consumption oriented. Consumption meaning staples, discretionary, retail orientation has been high. That has declined. And let's say, you will have to go back to a 2004 to a 2007 kind of a period when manufacturing capex used to be a larger part of the portfolios. I think in terms of portfolio construct, uh, after a long while, capex is forming a larger part. Supported by, yes, government spend. So we are not so much into construction companies. More into capital good companies, which are seeing very strong numbers. So in a quarter when that was not expected, if that happens, it kind of indicates that the order book outlook is reasonably strong. And while capacity utilizations are still not pointing to a need for a very widespread capex, what is really happening is you may be needing to retrofit. World has progressed. You can't run with fuddy-duddy kind of plants. You need to put in automation and all of that. So companies which are focused there into newer lines such as electric vehicle technologies, etc., I think are having a very good future, deep into the future actually. So that is a space which is increasingly finding representation in the portfolios, as is maybe defense. So there again, the outlook for growth is good for long.
Got it. So, Pratik, let me try and probe two or three themes, if you will, if you allow me. One of them is this capex theme, right? Now, the proponents say that if you look at ABB, Siemens, SKF, what have you, everything caters to this theme. The starting point of multiples may be high, but you are looking at earnings in a depressed cycle. In a proper cycle or midway through this up cycle, the EBITDA growth and the earnings growth will be tremendously high, and therefore the valuations look very okay. But the dissidents say that you should typically buy stocks in an environment that the market seems to be in at good starting multiples. Now, where are you on this argument?
No, so we are aware of both the arguments. We
I'm sure
believe.
you are. I'm asking your view, yes.
I'm just saying. So while the earnings growth should be good, one should prepare oneself for some amount of PE compression, and then see if it makes sense. If PE compression doesn't happen all at once, if it happens
Okay.
over a period of time, I think there is still a lot of money. When I say a lot of money, it means more than the index returns possible in the space. So that is the thought. In a period when there are a lot of tailwinds. So let us look at it this way: that in the past, when there were not such tailwinds, the businesses traded at particular valuations.
Right.
Now we are talking of growth accelerating. We were not talking of growth accelerating, let's say 2 years back. Now, with growth accelerating, theoretically speaking, a higher P should be supported by the market. Growth makes P's higher. But yeah, I buy the point that even let's say the start P was high, starting valuations were high. In that context, I am saying one should be ready to take in some amount of P compression, but really believe chances are that P's could sustain given the improved outlook. And this time around, outlook is not as cyclical as it was earlier. So the difference between, let's say, the last 2002 to 2007 cycle was that it was very, very narrow. Steel, power drove that cycle. Now this time around, it is diverse, and there is visibility deeper into the future. For example, railway capex. There is a talk of 200 trains over 2 years and then 400 over the next 2 years. So even that roadmap, if you see, it is an accelerating roadmap for 3 to 4 years now. So that was something which was missing for capex. Similarly, defense, which is the other bit of capex which government catalyzes, versus a 65% kind of indigenous content, if that moves to 75, even with an 8.5% growth in the budget for capex on defense, I think the defense companies could do just quite good. So I think that is something which is giving longevity to an otherwise very, very cyclical business. So I do believe there is a great chance P is sustained, while one should be ready to see some amount of compression.
Got it. Got it. So, okay, that's the difference, that you are constructive, but you are ready for some bit of a pain due to PE compression because you believe the cycle is here for longer. Got it. Thanks for
So,
explaining that. Huh.
yeah,
Please,
so
please.
our thought is to be with spaces where growth sustains at higher than index levels, not for 1 year but 3 to 4 years, and uh, uh, make a case as to how P's don't compress. So, if growth sustains at higher than index levels, so at the start point, we are saying index is fairly valued. Earnings growth kind of growth is what one should expect from the index. So, with the same logic, if the stock that we are in, the business that we are buying, doesn't see P compression, we don't err there, and growth sustains at a higher level for longer, we end up generating some alpha for our investors. And with that portfolio, have 4 5 bottom up stock ideas where things can turn out to be much better, maybe on account of growth, maybe on account of discount to value. That should result in significant alpha to our investors.
Got it. Does IT fit into this bill? Because while, as you said in your opening answer, that the narrative is all negative, there are green shoots. The Cisco Concall or a Coresight Research or other stuff kind of bring out that things are probably not as bad. So can IT surprise positively, Prateek?
Yeah, so I think last quarter it surprised positively. Uh,
Yes.
Practically nobody spoke of a bad future. On the cost side, people are now more stable, so costs are reducing on that count. If you see number of people employed, I think people overemployed when there was scarcity. Now we are seeing some amount of rationalization there, which is again good for margins. So, and like I said, while there may be some focus on spends in a period of economic slowdown in the West, uh, there will be vendor consolidation. And there, so that's one tailwind. We are the lowest cost providers of that service, so should expect Indian companies to win. The larger ones definitely, the sector specialists. If consolidation happens in that space, they should end up winning. But small caps who are diversified don't really. There is no great reason why one should go to them. May see some pain. So that, but and I think market is differentiating between the first two and the third. So I think that is the manner of seeing. What has changed is earlier they were getting pricing increase. Now, while wages stay good in the West, I think there is a reality check on pricing. I think pricing increases have slowed down, if not stopped completely. So, but still, versus expectation, I think because of cost side benefits, the numbers should come out quite okay. Now, in IT, it's an order book driven business. Okay, so larger IT, most of the business is order book. Order books today are looking good. So if you want to see, sales and profits, very little chance that one would be greatly disappointed. It's very predictable. For smaller companies where the smaller projects which are won and executed within the quarter are a larger part, is where you will see more volatility. But larger companies should be fine. I think it is the order book momentum that one has to be more clued on. There, the chances of the mix changing is higher. So it is not so much of a P&L kind of an issue. If suppose we have more of these bought out deals, what
Mhm.
changes is the ROC of the business. Versus, every time you do a bought out deal, shift, let's say an IT department of some company back into India, there is money to be paid upfront for that. That reduces the ROC of the business. So the quality of the business changes, but not sales and profits.
Got
So
it.
if you are sales
Okay.
and profit focused, then there is a chance for surprise. But if you're quality focused, in such periods, expect quality of the business to fall a bit.
What are you, Prateek? Are you quality focused? Are you sales and profit focused?
No, we are quality focused and
Your
profit
quality.
focused. So we follow
You will do a
a
mix of both.
DCF kind of methodology as well, where implied return, implied growth are all taken out, and which is why I'm making this point.
Got
If
it.
ROCs drop, even while profits may not, profits may grow, stock price may just stay where it is. So that is something one has
Got
to
it.
be ready about.
Got it. My final question, Prateek, and that is on a space that select people are turning constructive on, which is pharmaceuticals. Everybody's saying that the sector is unloved, out of favor completely. Valuations in certain cases like diagnostics are at the lowest that they have been. A good time to start accumulating. Are you in that camp, or are you currently out of favor with pharma
Yeah.
or
So
healthcare?
yeah. No, so what we did for the house was sit together as a team and define very narrow themes. So not call it healthcare, call it generic, branded generic, specialty, hospitals, maybe medical chains, maybe diagnostics. So those kind of narrow spaces. And we got all of our 9 managers to vote on what kind of allocation they want on each of these spaces, for example. And we did it for a whole lot of sectors. So, what came out was that as a house, we believed, hospitals are probably the space to be in. The runway for growth is very high. In fact, if you want unorganized to organize, the big brands, as soon as a not so big brand but with a great building associates with a big brand, there are benefits. So consolidation is happening. The need is there and very strong. And ultimately, if you see, while we are a very young country, if you look at the age cohorts, the elders are is the fastest growing cohort actually. Over 55, over 60 kind of age cohorts are growing very fast. So the need for that space would be very high, and it does not face the headwinds that let's say branded generics or generic faces. So generic might make money in 1 quarter, 2 quarter, then get slapped with one penalty or the other, and everything that you make goes away. Similarly, in branded generic in India, well, the growth in terms of IPM may be 10-12%, but because of some pricing cut, because of something or the other, what you get realized is lower. I think with hospitals making a case for a 15% CAGR seems very possible. So that has been our focus, just sharing a lot of what came out in conversation. So of our healthcare weightage, you see any portfolio of ours, 50% of that would be hospitals. 50% is, of course, branded generics. We are away from generic businesses. We are away from diagnostic businesses. Diagnostics, the profit pool itself. So one way is what happens next quarter and the next quarter. So yeah, after the pricing cuts, you will see quarterly growth completely possible. They also have a long runway of growth, but you continue to see newer entrants and good entrants, and they are not coming in for 100 200 crore profit. And those kind of guys have sold in the past businesses which made that kind of profit. So it means there is going to be fight for market share sooner than later, and the market carve out will be in more number of players versus earlier anticipated. So let things settle down, let number of players stabilize. We will look at it then. So as of now, we are not there.
Thank you so much, Prateek, for sharing some amazing insights. It's been a while that we've spoken, but it was worth it, and look forward to have you more often on the platform.
Sure, thanks. Have a good
The
day.
pleasure was ours. And viewers, thanks for tuning into this leg of the Talking Point.